Like this. Okay. So this will be recorded, and uploaded onto YouTube as a VOD. If you can search the same channel name and then just add and VODs behind it. Alright, so without further ado, let's just get started. Hello, good evening, and to those watching this VOD back, good day. Right, so this is actually lesson 4. We'll be covering more on debit credit. So in the previous few lessons, let's just do a quick rundown. Just so everyone's up on page. So lesson 1, we talked about the accounting equation. And also what is accounting. Right. Actually, I think it's more of what is accounting. I think that's lesson 2. Pardon me, my memory is quite foggy these days. So yeah, I mean, just intro to accounting, I guess. So, well, what is accounting, right? So I would like to think that accounting is documentation of a story. Story of who? It can be a person, like if you're an owner of the business, yeah, and sole proprietor, so you're the only owner of the business. You don't have shares to sell and all that stuff. Yeah, so you are the company basically. Yeah, so it can be a story of you, your business. It can also be the story of a company where it's well established and all that. The rules still apply. So accounting is pretty universal. People say it's the language of business. I don't. I agree with that. It is the language of business, and it's standardized so that everyone who reads, the results of this documentation, which is financial statements, they can get the same idea. So there's no misconceptions or like misunderstandings due to a difference in language. So this is why we learn accounting, or at least I hope you take from some of these lessons. Learn a little bit more about the language of business, and if you can apply it, in your real life, you can use it for your own finances. And yeah, to be honest, who can use it? Everyone can use it. Right, so how do we do it? Well, for accounting, we have a few sets of guiding principles. Slight differences when it comes to different countries, so you gotta read up a bit on your own country's accounting standards. Usually they're quite standardized, similar in most countries. The one that I'm more used to is IFRS, International Financial Reporting Standards. For our friends in the US, if you're watching this, you guys might be more used to GAAP, Generally Accepted Accounting Principles. And yeah, so do read up more on your own country's accounting standards to see if there are any differences, and make sure you follow your country's standards first. Right, so that out of the way, let's go into lesson 2 recap. Lesson 2 will just be accounting principles. And well, the first one that we learn is substance over form. So when you look at a certain transaction, right? Like say the boss give you a receipt. The first question you should ask is, well, what was this payment / receipt? What was the origin of it? Second question is, what is the intent? So, for example, say your boss bought a building, right? And they give it to you, say, okay, here, document this receipt. I paid some amount for this building, right? And yeah, document it. So you should ask, like, what? Well, I mean, the boss says it's a building, right? So the first question is kind of answered. The second question is intent. So you ask your employer, your boss, well, what is this building going to be used for? And yeah, depending on the answer, your accounting treatment will actually be different. So I went into more detail in that lesson. So if you are interested, feel free to watch that video before this. Most of these lessons are built on top of each other, so that's why I want to do a recap at the start of every lesson. And it's just gonna get progressively longer. Right. So yeah, that's and the last thing you want to note is are there any evidence to support this intention? So for example, you say, oh yeah, this item is meant for sale, right? Inventory. That's what we call it, a general term. Then you gotta see, yeah, okay, were there any prior sales of this item? If it's a new item, is it being kept in, proper condition for sale? All that stuff. Yeah. So these are sort of like evidences to support your judgment. So when say authorities come and question, oh, why did you classify this thing as such, you can actually answer, oh yeah, because these are indications that it's inventory, and it was also announced to me that the intention was to use it as inventory for sale, right? So something like that. All right, the second thing that we went through is the accounting equation. Basically, asset equals to liability plus equity, which I like to call not liability, right? So how you classify those, pretty straightforward if you're just starting out, and it gets way more complicated later on, but let's just start with basics, right? So assets, liabilities, and equity, all three of these actually have what's called history. So for these two, number one is there's a history. So what do I mean by that? There was an event that happened sometime before it became either asset or liability, that led to, well, the company having ownership over that asset or liability. So what do I mean by that? Say I bought a computer, right? So I paid cash, and in return I received a computer. So the history was that just that I paid cash for computer, and now I have a computer in my house. So that's something like that. The second criteria would just be possible / probable. Those two are different terms. We will use them a lot more later on, but for now, just keep in mind, yeah. Financial / economical. Okay, the proper term is economical, because it need not just be money. Benefits, for the case of assets, or outflow in the case of liability. What does that mean? So usually when you get, an asset like a computer or whatever, you're gonna use it to generate more cash for yourself. If it's for work, yeah, you're gonna use it to, earn more salary, things like that. Liability is something like, oh yeah, you took a loan from the bank, and right now you do have the cash, but you gotta pay back later with interest. So that's a probable outflow, right? So those are the two criteria for assets and liability. For equity, the same can be said for number one, but not number two. So what do I mean by that? Basically, this is what I say is not liability, right? If you can't call it an asset and you can't call it a liability, then it's equity. All three will have history, and we'll learn more about this part in this lesson actually. And yeah, so for example, let's just do a very quick one. Share capital. When you buy shares, right, from a company, so a company sells shares, the company doesn't exactly owe the shareholders any money. Okay, we're talking about ordinary shares here, okay? Just the basic vanilla shares. Yeah, the company doesn't owe their shareholders money. They pay dividends, yes, but they can choose not to pay the dividends for that year should they, their economic outlook is not that good, or they are not turning that big of a profit. So yeah, it's not an obligation, it's a privilege, right? So number 2 is actually not really fulfilled. So yeah, then you look at it. Yeah, the company might have outflow. You can't even call it possible or probable. It's just on and off. If a company is doing well, right? It's a condition. So number 2 isn't really fulfilled. Number 1 is definitely there is a history, right? They sold shares to raise funds for themselves, so they got cash in return. So that's the history of it. So yeah, then shares will be classified under equity. Okay, so that is accounting equation. Lesson 3 we went into right, debit credit. It's a bit covered. Okay, I think it's fine. The labeling on the side is just L1, L2, L3. Debit credit specifically for assets and liabilities. Because equity is more confusing to actually remember. The best way to remember debit credit for assets and liability, for me, is to use the accounting equation A equals to L plus E. So A is on one side, L plus E, or not liability, and L are on the other side. So whatever that's on the other side will be the opposite treatment when it increases. So for example, take asset. Okay, wait, let's start with liability. I like to start with that first. Right, so if your liability increase, so I like to use a credit card as the example here. Because credit card is you pay the vendor now and then you pay back the bank later. So history was you bought something on credit and the bank paid for you, so you got to pay the bank in the future at the end of the month, right? So that is clearly a liability, because you definitely have to pay it at the end of the month. If not, you incur more interest and all that stuff. So that's number 2 fulfilled. Number 1 is definitely there because you made a transaction. You paid cash. Well, sorry, you didn't really pay cash. You paid the bank's cash that you will owe the bank to get something. So when liability increases, credit. So because assets on the other side of the equation, when asset increases, debit. Right? So that is how I make the distinction. And not liability is on the same side as liability. So if we just add this, when equity increases, it's also credit, right? Okay, so that would be the recap for all these for the first 3 lessons. So now let's move on to the actual topic today. Oh yeah, I kind of overrun it. I'll be quick on this. Okay, so for those of you who know date coil or any other acronym, if it's easier for you to remember, just go ahead with it. There is absolutely nothing wrong with it. It's just that sometimes you can't find, the O in date coil and then you panic during the exams or something. So I tend to use the more logical approach. You derive it from the equation itself, so it's more universal. But this is absolutely fine. So you have debit. DR stands for debit, by the way. I don't think I've said it just now. But okay, debit, expense, right? Asset, and kind of can't remember what the D stands for at this point. It's something. Yeah, I don't use date coil at all, so unfortunately I can't remember this on the top of my head. For those of you who know, yeah, just feel free to shout at me in the comments. Maybe I'll remember in the future, but not now. Credit is, coil is credit, owner's equity. I stands for income, and L stands for liability. So if you realize, right, we covered this. We covered asset, debit, and we covered liability and equity, credit. Oh yeah, the last D stands for drawings, I remember now. Drawings only for sole proprietorships and partnerships. You can't see drawings in companies. That's why I don't remember it. I'm too used to doing companies stuff. So today we can cover expense and income. So why I say these two are important but not important at the same time. So if you do recall that asset and liability definitions and also equity definitions, right? They all share the first definition, history. Why is that? Basically, well, what I learned in physics back then was nothing can be created or destroyed. Yeah, matter cannot be created or destroyed. Same thing with accounting, you know. You can't really have cash appear out of nowhere. You're gonna have done something about it, right? That's why we say history. And how do we document the history? Right? It's recorded by income and expense. Okay. For me, I don't like using the word income, but some people prefer it, and that's fine. For me, I prefer revenue. It's just a personal preference thing, so don't mind me too much. For beginners, I think it's fine if you don't make the distinction. Right, okay, so let's go into more detail for revenue. Okay, let's just use the proper income, right? Using date coil, so it's more relatable for everyone. And expense. So, what does income document? It documents something that causes an increase in asset or decrease in liability or okay, and that's it, because income and expense actually form equity at the end of the year. So what I mean by that, it'll be covered more in detail in future lessons, but basically for accounting, we produce mainly 3 documents. There's a lot more smaller documents that support it, but the few main ones that we could cover is statement of financial position or balance sheet. Okay, statement of profit or loss or income statement. Okay, and then we have statement of cash flows, which is important, but is important for management and also for other people, but it's not as important for current lesson because we are not touching cash yet. So both income and expense belong only to the statement of the statement of profit or loss or the income statement. And at the end of consolidating all of everything, the income statement actually gets transferred to the balance sheet in the form of something we call retained earnings, which is an equity account. Right. So why is it an equity account? Well, the definition for me, at least I'll be using, is not liability, also not asset, but has a history, right? Retained earnings, it is, as the name suggests, what the company has retained after all their years of operating. So, for example, like this company has retained 1 million over 5 years. Quite a big achievement. And yeah, it has a history. Its history is literally 5 years of operations. And, all the cost cutting, all the marketing, the sales, all everyone's hard work. Yeah. And it's retained for future use, right? Usually being invested in different projects and all that stuff. But on the sheets, it says retained earnings, right? And it doesn't have to pay this money out to anyone. Sure, they can pay it as dividends. Again, I did say. But the company could choose not to, right? And if the company says, oh yeah, I'm never gonna pay dividends, then there isn't a cause for the second criteria for assets or liability. So because you can't say for sure it's an asset or for sure it's a liability, you can only classify as equity. So, and this is what I mean. And both of income and expense, right? At the end of the year, what happens is they'll be zeroized, meaning its balance will be removed to zero, for a very specific reason. Income and expense records for a period of time. So what do I mean by that? So for example, okay, it comes down to phrasing. So balance sheet is as at a certain date, whereas for income statement, it is for period ended at a certain date. And because both of these belong to the income statement part, it's for the period ended usually on 31st December for ease of use, right? So that brings me back when okay. So when income increases, usually you increase it for both. Generally, both expense and income will increase because well, that's how usually things are done, right? It makes logical sense. Yeah. So an asset increasing, if you can remember, it is debit, correct? And for liability decreasing, also debit. If you remember, when liability increases, credit card, credit. When liability decreases, well, you just flip the polarity, you get debit. And then since income statement is a okay, so this arrow you could see as a equal sign. Okay. Let's replace this with equal sign because it is easier to visualize mathematically. So if one side is both debit, right? So when income increases, it will be a credit. Same thing as expense, right? Expense usually results in either your asset decreasing or your liability increasing when your expense increases. I could go into more examples. For example, okay, let's just cite some examples, right? Your income increases. Sales is the most common one. If your company is doing manufacturing, you'll see this a lot. If your company is providing a service, it will be under service revenue. So you have sales or, service revenue. Yes. And then when expense increases, actually the most common one you'll see might actually be depreciation. Because most companies will have physical assets, and you'll learn this later on when we cover, fixed assets and all that stuff. When you use these sort of things, you are generating wear and tear, and you estimate the wear and tear using depreciation, and it's an expense. The other one will just be like, admin expense. EXP stands for expense, not experience, unfortunately. So yeah, let's go back. Let's go back to when liability increases. Credit card, again, credit. When your asset decreases, where you saw the example just now, when asset increase, debit, asset decrease, credit. So you see both scenarios result in a credit. So on the other side of the equation sign, it'll be the opposite. So when expense increase, you debit expense. So yeah, and debit credit is just a way for us to determine the plus and minus sign. So usually when you have like, say debit 10,000, in the balance itself, so for example, if you like debit cash 10,000, in the balance sheet, you just see cash 10,000. Okay. And if you say credit AP, accounts payable, let's use the same number. Actually, no, let's use a different number because these are two different accounts. I don't want to confuse anyone here. So if you represent this, okay, under something called trial balance. Trial balance is basically just all of your accounts in a list, right? So if it is in the same like trial balance, right, it will be represented with a bracket showing that it's a credit balance. Okay. We'll go through what trial balance is in a future date. For now, just remember it's a just list of accounts. So what are accounts? These are accounts: cash, AP, AR, your expenses, your income. These are all really called accounts, right? So, and yeah, to be honest, that is all you need to remember to actually derive exactly how to when to debit and when to credit. What happened to my my brain stopped working for a month? Sorry. Yeah, so when to debit, right? So one is you memorize it, two is you practice it enough to just know it off the back of your hand, and three, you can walk it through by logic using simple math equations. The equal sign is my best friend, and well, yeah, so I'll just list it out right now. When asset increase, you debit. When asset decrease, you do the opposite of debit, which is credit. When liability increase, I use the credit card example. Okay, maybe I should start with liability. Let's start over. When liability increase, credit card, credit. When liability decrease, opposite of credit is debit. Okay, on the same side of the accounting equation is equity, or what I like to call not liability, but that is not the proper term. So if you want to write in exams, use equity. Okay, you can remember it by not liability. Okay, so equity, when it increases, since it's on the same side as liability, you credit to increase, to show an increase. Okay, and to show a decrease in equity, you debit. Opposite of credit, debit. Right. And because income and expense are part of equity, you can remember it like this, right? Income increases your equity. Therefore, when income increases, you credit. And when income decreases, you do the opposite of credit, which is debit. Expense would decrease equity in the end. So when expense increase, you debit, and when expense decrease, you do the opposite of debit, which is credit. Right? Asset would just be on the other side of the equation of liabilities and equity. So when asset increase, you do the opposite of what happens when liability increase. So when liability increases is credit, right? So when asset increases, you do the opposite. So you debit to increase asset. And when asset decrease, you credit to show the decrease, right? So I know this is a lot to take in, especially for a 15-minute lesson. I did spend 15 minutes on recap. So I will actually go through this in future recaps as well. I think it's important to really understand, not just memorize it, because in the future you have a lot more things to memorize. So this is something that you should make it second nature if you're taking exams or if you're doing accounts. And bless you if you're doing double role as an accountant and as a clerk. And yeah, if you have any questions, do drop by any one of my streams. I do game on stream, but if you have any questions, I'm happy to actually answer them. Be it after one, like if I'm in the middle of a match or mission or anything, I'll drop it after I finish it. I don't want to leave anything hanging, to be honest. So if you are patient enough to wait about 20 minutes ish, I can get back to your questions immediately. If not, you could always drop a comment in my videos. That is the next best way. And I will read it maybe twice a week. I'll actually log on to see if there are any comments left, and I will answer them as promptly as I can. That's why I prefer on stream, because then I can get to it immediately. But if not, then the next best thing is to leave a comment. I can just answer you in the comment section. Or if it's too complicated, I'll actually, with your permission, show it on stream and answer it on stream, well, the next time I stream, which is usually Wednesday night. I think that is the best time for me, even though I'm also quite tired from work, but I'll try my best. And yeah, I will end the recording for this VOD and post this as a lesson on itself. But the stream will continue. Yeah. So for those watching the VODs, thank you very much for making it to the end. I hope you get something out of it. And if you don't understand, know that it's perfectly okay. All of us start somewhere, myself included. At the start, I really do not know. And I didn't memorize date core because my memory is quite terrible. So I go by logic. And that has worked out for me. So if you're someone like me who can't memorize, then by all means, use the logic method. It takes a bit more time, but it's solid, at least in my opinion. So yeah, thank you so much for dropping by if you're watching this VOD back. And I'm not sure if there's anyone in my chat right now. But if you're in chat, thank you so much for making it to the end as well. Do stay on stream. I have more. Oh. Yes, thank you, Roken. Alright, so yeah, for those of oh wait, the chat is on. Okay, I'll fix that later. So yeah, that'll be the end of the recording. I'll be transitioning to League of Legends with my friends. So if you want to stay for more chaos, by all means. Alright, thank you.